Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer, and today we are going to be examining 3M stock. This one came in by request down in the comments section of one of my videos. If you have a request of a stock you would like me to analyze and share my thoughts on, put it down in the comments section. If it's in the S&P 500, I share those here on YouTube for free, and if it's not in the S&P 500, I share those on Patreon, which is $5 a month. And if you join there, you get a big discount off the normal Cyclical Investors Club group over on Seeking Alpha. And those links will be down in the description. As always, this is not individual investing advice. This is just how I analyze stocks. So 3M is a really interesting one. I first started doing stock analysis full time in January of 2018, and 3M was one of the first stocks that I wrote about. I had done this like 3 years before this, kind of part time, but 2018 was when I decided to just kind of go all in on this and do it full time. And so I was a little bit new to the game, and this was a relatively well-read article in early 2018, which was the first time I covered 3M. And it doesn't show the ratings here because Seeking Alpha didn't have those yet, but you can probably tell from the title I was generally bearish on 3M. I don't think it was my most articulated article, and probably I didn't make the best argument that I should have in the article, but I ended up being correct. And really what I was warning people about here was that 3M could fall, quite deeply, especially in an economic downturn. And I really just wanted investors to be aware of that. And so that was kind of what the setup was there. I've changed some of my methodology since then, but you can see that it's down with dividends like 50%, while the S&P 500's up 63% since then. So it ended up being a good call. But what was interesting about 3M was I kept following up on it as the price fell. This article came out basically at the peak of 3M's stock price, so I almost picked the top with that. I didn't know that at the time, but that's just kind of how it worked out, because 2018 was actually kind of a downturn. I mean, that's why the Fed stopped. Actually, they lowered rates, I think, at the end of the year. So I was watching it fall, and I wanted to buy it because I thought it was a good quality business, but it was just too expensive. And eventually, later that year in October, it fell down to the price that I said I would start buying it in this article. And then when I examined it more, I just didn't like some of the things that I saw, like they were borrowing money to buy back shares, which just didn't make any sense to me. I mean, really, there was just a lot of financial engineering to try to prop the stock price up, and I just didn't like it, and so I decided not to buy it. And then I didn't write about it until, in a year and a half later or 6 months later. And then by that time, I had developed the full cycle analysis, which is what I'll use here, which I didn't have developed yet when I first started writing about it. And when I applied that to 3M in 2019, it was still a sell. So, and I'll go through that process here. I've refined it a little bit since 2019, but it's basically the same idea. And then right before the pandemic, as it was starting, I reviewed 3M, and I think the price had fallen more, and at that point it was like a hold. And then finally, after 3 years, I came back this year and wrote a little bit of a follow-up article. This was more about buybacks and just kind of the looking for this kind of things that don't make sense, and then maybe that's a stock that you want to avoid. And so it was kind of a dual article about 3M and Western Union at the time. So that was just earlier this year. And it was basically like a neutral article. Because the thing is, like, 3M stock price has fallen so much that we'll look at some of the numbers here, but I'll show you. So, yeah, I mean, you can understand why somebody would be interested in maybe taking a chance on it. So let's look just quickly. Yeah, my first article came out almost right at the peak. So down 60%. Um, so I ended up not buying this entire dip, and I've reviewed it a few times, and it's just kind of always been like on the edge, and I've always just said, nah, no thanks. And so the reason why that I'm kind of holding off now, if we get into the value, now they've had like lawsuits and they've had other stuff that's gone on too, but I mean, usually those things will eventually sort of work themselves out, and then if it's a good business, then they can eventually come back. So I definitely still track 3M. I think there definitely are like conditions where I would step in and buy if it was like the right price. But let's look at the latest kind of valuation and analysis that I have going on here. So let's start with what would rule out me buying it at all. And so this is the 3-year revenue growth number, and so this is cumulative. So if it grew 3% each year, it would be like 9 or 10% growth on this metric, right? So it's basically flat. So revenue growth is flat. When this is negative and there's not like a good reason for it, like some sort of like divestiture, a recession, just some sort of clear reason why they now companies will go year to year and revenues can go up and down, especially for the mature company. But usually, if you go 3 years, now you're looking at like a trend, and we pay a lot of attention to that unless it's like a cyclical business or something. So this is maybe not low enough for me to quite sell it if I owned it already, but it's low enough that I wouldn't buy it. I want this to be like 10% at least, probably, before I buy. So that would rule me out from buying it right now, no matter what. But it wouldn't necessarily cause me to sell the stock if I had bought it, at the relatively cheap levels at some point. So that's the first thing worth noting. The second thing is the earnings growth rate here is flat as well. So these are kind of matching up. Basically, they're almost identical. So that's because if you divide that by 3, you're getting like the earnings growth. And this is from 2015, I think. Let me check my dates. 2015, yeah. So, and if we go to the fast graph, we can see what they have for this time period. Let's see. Now, the thing is, I control for buybacks, so I'm going to guess my number is lower. It is lower, but not that much. So, fast graph, because this year's earnings aren't expected. I mean, they're falling 10%. So, fast graphs has 2% earnings growth. I have like 0.5% of earnings growth. Neither one of those keeps up with inflation, so they're struggling with earnings growth, but they are kind of holding their own to some degree. Now, they were borrowing money to buy back stock, which is totally stupid. Now, they have new management, I think, and I don't remember the last time I checked. I don't know if I might check my article and see what the latest trend is here. But so they have debt now because they were stupid and they were buying back all the stock like up in here. I mean, it's just totally dumb. Let's see. So it's good to just kind of keep an eye on those things. I want to see real quickly on my article because I don't remember what I wrote here. I want to see what's going on with the buybacks more recently. Okay, so this was through 2020. So they were buying back. This is when they were buying back all those shares. Let's see. That's revenue. That's debt. All right. So I don't know if I have any. Yeah, I don't have any closer. If I cut it off in 2020, that probably means they stopped doing it, which I think they did. But a person can double check that. I don't have it handy. So yeah, if you have a new leadership and they're going to be more rational with their capital allocation, and kind of take their medicine, which it looks like is what's going on. Now the question just is, can they get the earnings growth to come back? Now, if you watch any of my videos, you know I don't buy like turnaround stocks unless they've actually turned around, unless there's signs that are actually turning around. So I'm not going to step in and buy here, but if a person was thinking about it, when I run the numbers, I get So the way I would run this is I would take the PE ratio, which is 11. I would include their debt, which is about 25% more than the than that I would add to the stock price to get the earnings yield. So when I include that, I get like an earnings yield of 7.21%, which is pretty good actually. It's pretty low, but you expect it to be low because there hasn't been any earnings growth. So if you bought the company for $100, you would earn back $7.21 the first year. It basically would only grow 4 cents, so it's only growing like 0.5% a year. Um, and then you want to see how much you would collect on your $100 after 10 years, and you'd collect about $74, right? Yeah. And so when you do the CAGR on that, it's about 5.71%. Now, this is a little bit slightly better than the S&P 500. So basically, 3M's valued about the same as S&P 500 if you take this earnings growth rate. Um, Mine might be a little more conservative, probably because it is a little. This is slightly better actually than the S&P 500. I haven't looked at it exactly for a while, but it's closer to like 5.4, 5.5% maybe CAGR by my estimate. So yeah, if you put 1.5% or 2% in here, that's probably what this would go down to. So it's valued about the same as the rest of the S&P 500, but they're assuming a pretty low earnings growth rate. So it's not a buy. It's about the same as the market. It's not still a sell actually, just based on where the valuation is. So I would say it's like, if all this is correct, it's fairly valued. The question is, do you want to buy a business? Do you want to buy equity in a business that's not growing at the rate of inflation? And so I don't. One of the reasons I think you buy stocks, maybe the main reason, is because they can, if they have pricing power, they can adjust and they can control their costs. They can raise their prices to keep up with inflation. So 3M hasn't been able to do that over this time period. And it's not a short time period, it's a pretty long time period here. Now, analysts are expecting 8% growth next year and then 8%. So if you really got that 8% growth, let's just type it in and find out what we get. Now it's close to a buy. If this gets up to 8%, then that's a buy for me, right? So now I don't. I use historical earnings patterns to predict the future rather than what analysts are predicting for the future. So this is the big question here that I think an investor needs to ask themselves. If you think 3M can grow at 8% to 9%, starting here from this base going forward for like the next decade, then you could buy it here if you think that's the case. And analysts are, I mean, they're wrong a lot, but if you just give them the benefit of the doubt, you can make a case to buy the stock about right here. But I'm not one. I'm not one of those people. I'm really like a show me person. So now, if they pulled this off for a couple years, the stock price would probably go up, and then maybe if something happened that would push it down, that would probably be where I might end up buying it. But I want to see this revenue growth come in, and I want to see the earnings growth come in and kind of prove to me that we're on this path before you step in. Because you could have made this case right now that I'm kind of playing devil's advocate for. You could have made that all the way down. I think when I first hit my kind of looked good was right in here when I decided not to buy it because of their capital allocation. So all this whole time, if you were optimistic that this 9% growth could keep going, it looked like it could do it, but then they failed all along here. So yeah, I'm kind of, you got to show me first at this point before I'm willing to step in. But if they do it, there'll be some smart people that took a chance on it, down here, and they'll do really well if they can actually pull off this for the long term. And the people that are buying right now will look pretty smart, I think, because that 8% return CAGR once this stock price adjusts for that, I mean, you're going to get very, very good returns if it happens. But I'm not in that camp, so that's how I would think about it. Um, but I'm watching it, so choose your own adventure, and good luck. All right, if you guys have a request, put it down. If you like this video, hit the subscribe button, and I'll see everybody in the next video.